Hello everybody, Mike Bell here from the Armchair Trading Floor. Hope you're all doing very well. I just wanted to do a quick video just to give some insight and a bit of an update in terms of the content that we've been producing over the last couple of weeks. I feel that it's something that is very much valid. We've had a lot of positive feedback from it, especially when the majority of people are going to be shouting doom and gloom, etc. We are obviously here to let you know that realistically, on a macroeconomical scale, it's actually probably not as bad as most people will obviously think that things are. So I'm going to give you an insight starting off with looking at gold and our analysis on gold, and also what we've previously said as well. So just so that you know that, number one, we are giving you an update. Number two, we're actually revisiting what was predicted beforehand. And then number three, we're going to give you an overall basis of synopsis and kind of where to go next. If you are obviously interested, if you are wanting to try and understand how to make your next move based upon potential market movements as well. So just to start off, obviously, I believe it was about a week ago, we sent this email to our email database to basically say that gold is set to hit 2,900 per ounce, but now is not the best time to buy. So at the time, that day's market price, gold was 17.16 per ounce, and I'll revisit this on a live example. Sure, even though if from that price gold was to be set at a 65% increase to hit the 2,900 an ounce, that would obviously be a fantastic return. However, it's probably not the best time to be buying gold, and I'm going to explain that in terms of the previous content that we've sent, etc. So because gold is naturally and historically being looked at the safe haven for, if there's an economical downturn, then most people will try and look to buy gold to store its value, etc. But because we've broken down the macroeconomics and some of the factors in terms of GDP that's expected, we've looked into the different sectors, we've actually had a look at the technical basis of the charts to analyze this. We know that the probabilities of a recession is very, very, very minute in comparison to what the mainstream media is predicting, and also what every man and the dog and John down the pub is trying to kind of scaremonger on social media, etc. So we can expect a false breakout in between 1750 to 1760, and then we can go all the way back down to X, which is obviously being shared with the people who I'm associated with, then to fly high to 2,900 per ounce. So I feel that, number one, if you aren't in gold right now, don't get in gold. It's not the right time to be buying any type of gold. Number two, what you need to do is kind of scope out the price. So I'm going to go to a gold chart right now, and I'll actually show you from the point of when we sent this previous email. So I'm showing you right now, this is the gold chart on the daily time frame. So we can see that there's a couple of things that we've obviously highlighted in terms of respected zones and expected targets. Now, for a gold sell, realistically, gold, I'm going to give you this one, but I still don't think this is the best price to buy gold, and I'm not going to obviously share that right now, because I feel gold could quite comfortably hit 1565. There is kind of no real rush at the minute, but I do think that within the next 5 or so years we are going to see an increase to around about this 2.9 region, which from today's price would actually give you, because gold has actually dropped a bit more, would be a 70%, 72% return if you bought gold. Now, sorry, if you invested in gold. So from the point of taking a look at this, and I'll show you the previous marked up idea as I just zoom in. So you can see right here, obviously we've got a risk to reward, not the best risk to reward ratio on gold. It was actually published on the 14th of April. So realistically, for the full members, they were given a 1 in 5 risk to reward ratio like this. So if they were risking 1 in terms of a short to gold, they're going to get 5 based upon hitting this downside target, which I'm quite comfortable you are going to obviously see. So starting off, you can see a bit of drawdown, but gold is pushing down nicely, which is very, very interesting to see. Previously, what we mentioned on another email, if you are a part of our mailing list, is before gold actually spiked up to this region, when gold was at 1627, so when gold was even lower than it was before, we mentioned, and we actually had this before picture here, which said gold is going to be pushing up from 1627, and notice how we had it there in between 1720 up to 1760. Again, we can actually see the height of the price that gold has returned from is between 1720 to 1760, so quite comfortable in terms of we had this push to the north side, so that prediction was actually correct. What else we covered in this email was, number one, people are going to have their eyes opened. Obviously there was a lot to take in. The economical stimulus, so there's a term in macroeconomics which is a financial term called economic stimulus. You can see that we prepared for this even before it was announced by the US, by Great Britain and other countries that are doing something similar, when most people are thinking, right, it's a bailout, but in reality a lot more people are going to financially be better off coming out of this, even though most people hinder some kind of short-term pain, etc. The long-term prospects of it is going to boost the economy. The fiscal measures are going to be manipulated by the government. So if you look at our previous content or our previous posts in relation to how we expect the next forecasted GDP report to be pronounced, it's more than likely going to be a clean manipulation to present the figures to actually stimulate the growth of the economy. And then finally, so gold price has recovered. So from the 3rd of March drop, which we can see right here, when everyone was shouting doom and gloom, the gold price has actually recovered over 100%. It's actually recovered from the highest point and created a brand new multi-year high. So there's a few clues that's happened right now. So number three, we're now going to be experiencing what's called the multiplier effect. And again, I'm not just making up these terms, these are macroeconomical terms that you can research and try and understand in a bit more depth, just to give you a sense in terms of your financial education or financial literacy. Unless you are understanding the basics of macroeconomics, you can utilize this to benefit your other investments if you aren't in the markets, if you're in property or if you're in business, etc. You can use these terms to your advantage to kind of give you an edge in terms of forecasting what you see the next bias is going to be. So just to quickly summarize, we're going to experience the multiplier effect, so that's an injection of new spending, government spending, investment. Again, we can see that especially here in the UK. The base rate has been reduced again to like the lowest low historically, and I feel that this is going to stimulate a lot more borrowing when we actually come out of the danger zone in inverted commas. So price fall done, we've seen some technical support done. We actually predicted this crash back in October the 25th, 2019. So again, if you wanted to read more on that, visit our social media posts or send in an email. I'll be quite happy to share the video and the write-up of that report that we did. So government introduced fiscal multipliers to stimulate the economy, again done. Banks using macroeconomical policies, again done. By lowering rates, the economy is going to grow and regain strength, done. And we can see this based upon, if you're in the UK, you can look at the FTSE, but again, the SPX, which is what we did our initial analysis on, was the S&P 500. Now we can see that this is actually recovered. We predicted a minimum of 40%. We can actually see that this is actually recovered round about 60% now of its previous collapse, which on a larger scale time frame wasn't really even a crash. It was more of a correction because we only dropped down around 29%. If the market corrected, again I'll zoom this out on a monthly or weekly time frame when there's a lot more data. If the market corrected maybe around about 50-60% of this from 2008, then I would be getting a bit more worried when we are getting into like the 1,800 to the 2,000 territory. When we're getting around this kind of territory, that's when you need to kind of be worrying and thinking, right, what do I do? Am I too late to enter the party, etc. But going into gold, we can see that we've already bounced back. We've bounced back, returned to new highs, and we're just playing out the next phase within this market cycle. So nationals across the globe are all sat in fear. So they take you're going to see people being teased and taking advantage of cheap loans, business loans, grants, cash flow strategy, anything to try and accumulate cash. Again, I'm seeing this happen as we speak. Media claims fixed on COVID-19 and highlight markets recovered. Again, I believe this is more than likely to start flowing in from Thursday this week, which would be, I believe, the 24th. So we should use this as an advantage to take advantage of the stimulus, and you're going to see people are going to start using and coming out of this the other side, especially the ones that were extremely fearful, that might have thought, right, it's going to go Pete Tong, they're going to utilize borrowing, etc. But then they're not going to actually need the cash that they've borrowed. And what's more than likely going to happen is, and we can see this and we can imagine a cycle of, we get the stimulus pays people, we don't actually need the stimulus, so then people are going to sat on surplus cash. We've not had a psychological habit there to be able to sustain that extra inflow of cash flow. So more than likely, you will experience frivolous spending and back into previous habits, which will be, we are going to then enter into that multiplier effect. So people are just going to pool all of this surplus cash and the stimulus money back into the economy as well. So the economy will then grow as that fiscal multiplier theory, and the multiplier theory comes into effect. Now, where are we now on the S&P? So you can see right there, this drop we called the 2,400 region. We spiked into this zone market. The buyers re-entered the market, which was a very, very clean move. I think that we need to see 3,180, and by the time, 3,080. By the time we see that, we are going to see COVID-19 is all over, blah, blah, blah. Everything's relaxed. People are going to see normality. So I still think that there's going to be a few more weeks into trying to push to this higher price because we are going to hopefully start to see some sellers re-enter in the market and trying to target these lower end of the range, or realistically back down to this 2,400 region. Taking this into a smaller time frame now. So again, if you check our social media content or the previous emails, etc., we were calling you should be buying stocks, etc., around this region right here. Anywhere from the 19th of March all the way up to the 26th would have been an ideal time, but the market dropped again. So we were back into this territory again. You can see that on April the 5th, we published this, which basically said that we were going to be heading up to this 3,081 level, which is what I called. This would be classed as the normal supply zone. So we would expect that we're pushing from demand back into the midterm supply on the lower time frame, and then we'll more than likely see some kind of fall back and correction into these lower prices. So far so good. You can see again 1 to 3 risk reward. The price is pushing up. Let's just wait for a couple more days before this starts to hit and get into that 3,080 territory. So we've covered a couple of things there in terms of gold, what we're looking for, and then finally I want to cover one of the very first emails. So this was the first email of this series, which we decided to publish to our mailing list, which was that we saw the stock market dumping, we made an accurate prediction, and again you can see from here, from October the 25th, 2019, this was when this was when we expected that as soon as the price starts to getting over, 3,000 a share, then we're going to see some interest in terms of sellers. So the current price sits slightly over 3,000 a share. At the time of writing this, it was the 25th of October 2019. Again, understanding market movements, we tapped into psychology, etc. I'm not going to revisit all of this, but you can see our previous chart, we highlighted this 2,400 range, and we also highlighted this 1,800 range as well. Begin to leave some clues. So price literally beginning to leave some clues. There is a price gap at 2,400 which needs to be filled. So the price wicked and retested, but this needs to be filled. So this was back in October last year when I written this. Again, that price has been filled, but we pretty much have filled that and the buyers have entered into the market, which is quite nice to see. So that was before, and obviously this is the after down there. So that's it. Just understand or try and even do some research in terms of macroeconomics. Number two, don't listen and believe everything you see. Do your own research and just make a plan based upon understanding, because you can see from this example here, even though I'm showing this as a 1 risk reward, I'm showing this, but the members that were obviously granted this beforehand on April the 14th, we're giving it as a 1 in 5 risk reward profile. So I'll check in on this one. Feel free to obviously keep watching gold, but keep an eye on gold price, and you want to be staying well away from gold until we kind of get somewhere. I'm not going to give exactly where I expect the market to begin to turn, and the ideal buy price. I will update the members for that in the near future, but take a look at that and stay safe, stay trading.